Started.
Good afternoon, and welcome to Managing Banks' Newest Emerging Credit Risk. This webinar explores an approach to managing the newest emerging credit risk that bankers face today using common sense credit risk management practices. Learn about identifying climate-related credit risk in the loan portfolio, how to track it, and tools and techniques to successfully manage this emerging risk. We will also detail a recently completed proof of concept with a bank using climate-related risk scores. Thank you for joining us. I'm Kia Haslett, the Banking and FinTech Editor at Bank Director. I write about balance sheets, accounting, operations, strategy, and M&A trends. This webinar is brought to you by both Bank Director and Ardmore Banking Advisors. An information resource to the financial community since 1991, Bank Director focuses on the strategic issues most fundamental to a bank's CEO, senior leadership team, chairman, and independent directors. Ardmore Banking Advisors is a market and thought leader in credit risk management consulting, recognized for its expertise in loan review, credit risk consulting, and credit technology that delivers value-added results to financial institutions. Since its inception in 1991, Ardmore has provided credit risk management consulting services to banks nationwide and built an unparalleled reputation for integrity and expertise with both clients and regulators. Ardmore's team of seasoned former senior banking executives and regulators ensures that their clients receive the highest quality services and solutions from professionals who have been in their shoes and share their experiences. Each member of their consulting team has a proven track record of credit risk management experience, expertise, and insight. We are offering CPE for this webinar. In order to qualify for credits, you must be in attendance for the full and complete webinar, and you must participate in all 4 polls. If you want to receive CPE credit for this webinar, please email Taylor Zito at tzito@bankdirector.com. Certificates will be sent out 2 to 3 weeks after the webinar. Before we get started, let me share just a few things to keep in mind. First off, don't worry, we can't hear you. You have joined this webinar in listen-only mode. We recommend that you click on the slide bar at the bottom of the screen to adjust between the presenters and the presentation. If you have questions for our speakers, please note them by clicking the Q&A button found on the right side of your screen. You can do this at any time during the presentation. Once our presenters have finished with their talking points, we will have a Q&A period where those questions will be addressed. There is no need to take detailed notes, as the presentation will be shared with all attendees within 24 hours via email. It will also be available on bankdirector.com. If you have any technical issues, you may also note those using the moderator chat feature on the right-hand side of your screen, and we'll do our best to take care of it. Regarding our polls, those will appear in the sidebar near the Q&A button. When you've selected your answer, just hit the vote button to submit your response. Finally, the opinions expressed in this webinar are those of the individual speakers only and do not necessarily reflect the opinions of the other speakers or of the entities with which they are associated with. On that note, let me share a little bit about our speakers today. Peter Cherpak is a partner and EVP at Ardmore Banking Advisors, Division Manager of the Credit Technology Group, focusing on credit data management and risk control automation for community and regional banks. Peter has been with Ardmore since 2002, specializing in assisting financial institutions with credit data management best practices, CECL transitions, stress testing, loan review, and reporting automation. Peter is a nationally recognized thought leader in best practices for credit data management, stress testing, and CECL's impact on community financial institutions. A frequent speaker making presentations to regulatory agencies and organizations including RMA, ABA, WIB, and CBANC. He is also frequently published and cited in the American Banker, Bank Director, the RMA Journal, and other industry periodicals. Before joining Ardmore, Peter worked for nearly 20 years at PNC Financial as Vice President in Network Services Division, supporting bank-wide projects involving technology support services. Kate Dixon is the Senior Vice President, Director of Credit Review at Heritage Bank, and is responsible for monitoring the lending portfolios and executing loan review plans. Kate reports quarterly to the Risk and Audit Committees of the Board of Directors and is a member of the Enterprise Risk Management Leadership Team. Kate holds her certification as a Certified Fraud Examiner from the ACFE and holds the Credit Risk Certified designation from RMA. So with that, Peter and Kate, please take it away.
Well, thanks, Kia. Good afternoon or good morning to all of you, depending where you are. I'm Peter Cherpak, as introduced, and at Ardmore Banking Advisors. My company's been around for over 30 years, and we try to assist community and regional banks with credit risk challenges. And I think that's what we're going to talk about today. And I'm very pleased to have Kate Dixon with me, the Director of Credit Review for Heritage Bank, Tacoma, Washington, who was participating in our one of our proof of concepts. So we're going to get started by finding out a little bit more about you. So we have a poll question. We actually have two of them. So if you can see on the screen, the question is, what is the approximate asset size or institution? $1 billion, 1 to 10, 10 to 50, and more than 50 billion. Now, you non-financial institutions, you don't have to vote, because I didn't put an other in there. So we'll give this about a minute, just to get a sense of who's on the line and the population we're talking to. Hopefully it's a pretty wide group. So we'll give it a few more seconds. Yeah, so is most of the votes in by now? Okay. All right, so it looks like we're done with that. We've got primarily 1 to 10, but we do have representatives of all the different asset size groups, so that's great. Let me share my screen so I can that. Okay. All right. All right, so we have one more poll question. And that is, oh, sorry, should I have here? Please indicate the region of the country that your institution is from. And again, give us a little more information about the demographics. So we'll give that about a minute. You know, it's interesting as we get into this topic area, regions do matter. We found, since the proof of concepts we're going to talk about, one bank was in the northeast and one was in the west. Definitely things are a little bit different with this concern. So let's see if the poll is going. Take a look. And let me get the results. Okay. So it looks like mostly northeast, but we have just very little from the west. I guess it's a little too early for those guys. Okay, great. Thanks very much for participating in the poll. We appreciate it. And now we'll get into this discussion for the next 45 minutes or so, and then there will be time for questions at the end. So first thing I want to put on the table for everybody is this is not a presentation about climate change. I do not know very much about climate change, and that is not the intention of this presentation. This is a business problem that banks are starting to face, and that has to do with climate-related credit risk. So this is a credit risk discussion. That's really what we're focused on, which is it's a business problem. So what I'm going to do is I'm going to use these talking points and introduce some ideas, and then and Kate's going to jump in where she wants. You know, I actually want to start describing the business problem by quoting the FDIC's Vice Chairman Hill, who published a speech about the insights on the FDIC agenda less than a week ago. And in that speech, he referenced the climate-related credit risk issues, and he referenced the FDIC principles that they published about a year ago, really for larger institutions. But basically, he restated that the FDIC, their principles significantly elevate the relative importance of climate risks in many aspects of banks' decision making. And he kind of said an interesting thing after that about how the agencies are telling banks to worry about it themselves. So they are not telling banks how to act, but they're telling them to worry about it. And their expectation is that banks are worrying. So it is a problem. And it's a business issue that's got the attention of not only regulators, including the SEC, but boards of directors, bank management. It's in the front pages of the newspaper or on your feed. You hear all about it. So the question is, what is an appropriate response today or in 2024? What's the appropriate response, particularly from banks that are not under any rule to make any response? That would be regional community banks. Anyone but the really large banks, there is no requirement to do anything today. But as we are all credit managers know, it's always best to get ahead of risk. You don't want to be the one dragged across the goal line at the end, being told what to do by regulators. That's never a good place to be. But even in the FDIC's remarks from last week, they said, the risk is lower now than in many other risks. So it would be inappropriate for a smaller bank to commit a great deal of resources unless they have a specific niche in this area. So what we did was we wanted to come up with a way to help banks raise awareness of the issue within their bank and create a baseline understanding of what the impact of climate-related credit risk could be. I mean, this is an emerging risk, and emerging risks should be paid attention to, but there really isn't very much information going on in most institutions about the risk and what it means. We want to be able to inform our board and our management of with the opinion of risk professionals about this risk. And we want an appropriate response with the resources that we have available to us. We're not going to go out and invest a lot of money in doing this now. So we did a proof of concept that we could actually go ahead using common sense and easily accessible credit tools and practices and get into what is to climate related and we can first step. Kate Herden is one of the institutions and part of this. Her institution is a $7.3 billion bank out of Tacoma, Washington. And Kate, this was something of interest to you when we talked, the very first time we were talking about loan review strategies. Do you have anything you want to just to add to that?
Well, I just think that during the inquiry that we originally had a long time ago, probably well over a year ago now, as well as the information that's come forth after that, both from the regulatory bodies and just the headline news and whatnot. I think, the main concern for me was to try and get educated enough to develop a perspective how to evaluate this, how to understand whether it's a risk, how to understand in credit terms, how to identify, like with any concentration, they can live in different areas throughout the loan portfolio. So for me, it was both an educational kind of perspective that I was looking at. A lot of the very large banks publish some information I think we originally talked about, but that's a lot of information. It's a lot of detail, and frankly, it would just be way too much for a smaller institution, approaching $10 billion like ours. But we are, we're located in Washington, Oregon, and in Idaho, of which we have, probably similar characteristics to those on the call. We have coastlines we're dealing with. We have rivers, mountains, we have drought, all of the different things. And even though bankers are the first risk people when it comes to dealing with borrowers and identifying that credit risk related to these type of things. I thought that the approach that Peter put forth was really a very simple approach that could give you the perspective that you need to be able to really move forward and understand your particular bank's portfolio. So.
Okay, thanks, Kate. Okay, so what was the proof of concept? What was our approach? It's really to deal with the two main aspects that banks are measuring today, because if you can't measure and monitor risk, you can't manage it. So the acute physical risk or physical risk of climate-related credit risk is the concept that is, what in your face today, the headlines, the alerts about the physical risks that can happen from a natural disaster, which isn't even necessarily climate, because, for example, an earthquake isn't necessarily a climate event, or a volcano, although hurricanes and wildfires tend to dominate the news. There are a lot of physical risks out there, and these have an impact potentially on your institution's collateral, particularly real estate, obviously, the business value of the collateral itself, and its ability to come back and function and pay for credits, as well as even the location. So acute physical risk is something we want to try to measure, if at all possible, and we would do that by looking at the geolocation of the borrower's collateral. This is obviously easiest to do with real estate, harder to do with C&I, and we'll talk about the challenge there a little bit. But I think, in fact, it was in the FDIC's own statement that there have been 23 incidents so far this year of over $1 billion of loss from an acute physical risk event, and that is a record. It passed 2020, and we're not done yet. Hurricane season is upon us. So that's the physical risk side, and we'll talk about how we're going to track and monitor that. The other type is a little fuzzier, and that's the transition risk. This is the concept that people, consumers, investors are shifting away from high carbon footprint technologies, businesses, industries, and shifting towards lower carbon footprint alternatives. The concept that is commonly shared is called orphaned assets. The idea that a bank might be holding, let's say, loans to mining or manufacturing areas that no longer have value because they're simply, not popular, not used, and people have shifted away. This kind of risk is a longer-term view. And in fact, that's a challenge because some of these risks are things that people are looking at 5 years from now or more, and how banks can deal with a slow migration is something that is a bit of a challenge for risk managers, particularly if the risk we're talking about might be further out than your typical planning cycle. But it's real, it's there. You can see it in some of the impact of local government who are making rules about not allowing, for example, gasoline combustible engine cars on their lots in 2030. You wouldn't want to be holding a lot of loans to those kind of car dealers if that's the truth. So it is real, but it's harder to track. So what we look at there are industries, using industry codes for potentially higher carbon footprint exposure. So those are the two areas we focused on. The impact today is, there aren't any rules yet for banks that are community and regional, but we know those rules trickle down. Anyone involved in banking knows that the big banks go first, and then the other banks will follow. So, but there are some immediate impacts of these risks on the bank, and one of them is obviously insurance. Everybody's certainly read about the troubles in Florida and California, and how some some of you can't get insurance in some states, and those that you can get sometimes have carve-outs for this sort of risk. That's real, and disclosures are coming. Requirement for disclosures, and we'll talk about that in a little bit too. So that's really where the impact is today. And the techniques we use on the physical risk side were to track using a risk indicator code. We didn't want to go out and buy them, although you can. We don't think that's an appropriate use of resources. Now, you might actually have a subscription to a service like a Moody's, who actually offers a risk score for geographical locations. But we thought it would be more appropriate to use free information that's available, and we use the FEMA NRI, National Risk Index, which is a free service. They have a database of risk ratings at the county and census tract level. And it's updated frequently. It's got a lot of documentation. It's got a lot of detail, as much as any banker would want. So that's what we're going to use for the physical risk in our proof of concept. On the transition risk, we have to use NAICS codes, industry codes that are associated with what are higher carbon industries. This is, again, a fuzzier, more directional type of assessment because of the fact that industries are not extremely detailed, and different companies have different ways of doing their jobs that could be lower carbon or not, but it is an indicator of potential risk. And I think, maybe what it's interesting to Kate was the idea of saying, hey, we can do this, and we can do it now with the tools that we have, and it's not going to be, a large expenditure. So that's kind of where we are today. As far as tomorrow is concerned, we know there's an SEC rule that's coming, that's going to be released supposedly this fall. It's been delayed several times. What exactly it requires, we can talk about later on, but disclosures for sure, where you're going to have to disclose different information about your institution's contribution to carbon and greenhouse gas emissions. We know that's coming. We also know that there is interest in what they call the value chain of banks, and that would be their borrowers, and what are their contributions to the issue. So that's something that's coming, as well as operational risk concerns. You might have a borrower who is in a very high location, so it's not going to get flooded, but all around them is low, and so people can't get to work and they can't get their goods out because of floods all around them. Operational concerns about how one borrower's possible contribution to the problem could impact other businesses around them. So there's a lot of aspects in the future, and again, local governments taking action. And Kate, you're Washington State has already taken some action, isn't that right?
Yes, that's correct. There's quite a few initiatives that the legislature here is moving forward with on policy. The vehicle sales of gas cars are one of them. There's some drought initiatives, other things. So, the thing about this is that the physical risks and the transition risk, the physical risks for sure are outside of our control. We can't control the impacts of climate. The policy decisions we get to see coming a little bit sooner. And so when some of those actions were taken in the last couple of years, that really got me thinking about, well, because credit portfolios need to transition slowly, borrowers and other types of risk or risk appetite for those specific type of loans transition slowly. So identifying physical risk is really the beginning step to understanding the potential for the transition risk. And so because our state has been pretty active in this space, it's important for us to stay ahead of the curve.
So true, so true. And again, it's an interesting comparison, the proof of concept that we did for the bank that is a regional bank with holdings in Florida. It's a whole different profile, as well as political environment than, for example, Washington State, where you are. But it's an interesting contrast. All right. So the proof of concept itself, what we did, and we're happy to share more detail with those who are interested. But essentially, the two banks, Kate's Bank and another one, were interested in understanding more about the foundational aspects of climate-related credit risk. And what we did was take this simple approach of saying, let's use the concepts of, as Kate mentioned, concentration management, and as well as tracking and trending those concentrations as a first step. Because, it's what you don't know that credit people worry about and risk people. So the more you know, the less you have to worry, at least in theory. So, first, the real proof of concept is say, can we do it with minimal effort and resources? And is it valuable? Does it make an impact would it make an impact being translated to the board or to the bank's management? And looking at both the transition and the acute physical risk. The justification of doing this, I think, is that no matter how you feel about the issue, it is another risk. It's an emerging risk. Loan review departments, credit risk departments, and risk management ERM departments are all, considering that this is a risk. But there's so little information about it. There's really very little typically in a bank other than trying to raise awareness of it. But I know that I can tell you that one of the things about working with bank director, which we really appreciate, is having exposure to bank directors and the fact that they are very interested in this to understand whether or not this is something they should be concerned about and how soon they should be concerned. So being able to keep your board apprised of emerging risk is really a key value add, whether it's coming from the credit review group as Kate manages, or whether it's coming from risk management or some other part of the bank. The justification is to know more about another emerging risk in the portfolio and whether or not it's something to be monitored or concerned about, or whether or not at this time it's not. So the key components really were getting the NAICS codes and getting the NRI codes associated with borrowers in the portfolio and loans. The NAICS code side is tricky. There is no central list. Naturally, the first thing you'd want to do is say, well, I'm going to go use the official NAICS code high carbon list. Well, there isn't one. And you're not going to get one certainly from the regulators, because U.S. regulators would be very politically incorrect for them to designate any particular industry as being bad. And there is no published list from any U.S. group. There are European lists or Canadian lists, but they don't all use the NAICS code, which is the common code that bankers use for industry. And those of you who aren't familiar with that, it's a 6-digit code that gets kind of detailed down to the 6th digit. The 2-digit is the highest, and it goes down from there. So it can be tricky because, as I mentioned, not only are there variances within industries, but also the codes themselves aren't particularly clear always. And again, CRE is part of the problem as well. As soon as we did our first proof of concept, CRE jumps off the page as being a very high carbon emitting industry. Well, CRE also jumps off the page as being, for typical banks, other than ag banks, usually the largest holding in their portfolio. What you really don't want to do is start out a proof of concept by saying, well, 75% of your portfolio is bad. So that was a bit of a challenge, and we tried to get to a little more detail. And we did find some information from some of the government agencies that do assessments like the EPA, that shared infrastructure tends to bring down the carbon impact. So a multifamily project could be significantly less than, let's say, an office building, which might be one of the highest emitters. So there are ways that you can actually start to get a little more granular there. But because you have to create your own list, it's really up to the bank to decide what they consider to be potential industries will be transitioned from. And if you want to make your own list, you can go out and read all kinds of industry information that lists what industries are considered the most high impact from a carbon footprint. And you can make your own list, then go into the NAICS code and you can search for them. Ardmore made a list, and we shared it with the folks who are were in proof of concept. Again, it's not perfect. It's directionally correct. We'll talk a little bit more about that. I'll give you an example. Also, on the acute side, I mentioned the geolocations and the risk NRI, National Risk Index. The trick here is to get the geolocations of the borrower, not their home addresses or their corporate addresses necessarily, but the location of the assets. Not all banks have that. I mean, let's put it another way. Not all banks have it readily accessible. We were fortunate enough well, the first case we used County. County is one of the options you can download for free, database of county NRI codes, and then associate them with loans and put them into a user field. And they do get a score for the NRI. The problem with county is that that's a pretty big location. So you might have a building on the shoreline and a building that's quite inland, all in the same county. Census tracts are better, and Kate was able to source census tract information for her proof of concept. You were looking at using CRA information, Kate. That's how you were able to pull these out.
Right. Yes, the geocodes used in the CRA data. And so part of the challenge that, part of the objective, not only getting a baseline portfolio review with this perspective to be able to comprehend the loan portfolio in a different way. The other impact that I think was helpful is to understand where there's gaps in the data, as well as where else in the bank the data may exist that could help us fill this picture in a way that makes sense for this particular look. So yes, that was we were able to source it from CRA and some other compliance data.
Well, I can tell you, having worked with the data myself, and I'm not a data Excel jockey, that it's a daunting task when you get into the census tracts because they're so detailed. You're probably going to need some help. Even downloading the census tract database it's so large you can't really readily do it. So counties might be an easier fit as a start, but granularity in the location is going to give you more good results. I'd say anything is better than nothing, but there are challenges. And one of the things Kate alluded to was one of the byproducts of this, the first proof of concept we did was that board of directors had never seen concentrations based on location. It's geolocation. It's not that common in community and regional banks to discuss that, as it's not typically considered a major risk issue. But when you start talking about climate-related credit risk and some other challenges based on local laws, insurance, and things like this, suddenly understanding where your portfolio is concentrated geographically, it becomes more important. Let's take a look at just an example of a NAICS code list. I don't know how well this comes across on the screen. I can send you this if you need it. But Canada, our friends up the Great White North, they did create their own list using NAICS codes, which is great because that's what, like I said, most financial institutions have. This was a project done in 2022 by Bank of Canada. And you can see they identified sectors, which includes coal and oil and gas and other services. Mostly they pick 3-digit NAICS code, which are pretty wide. But there are some in there that are also, you can see 6-digit, particularly under the electric, because, for example, wind electricity generation is, code 22115, and if you just put in 2211, you'll accidentally pick that up as well. But this is just an example of a list you might want to use that could be considered directionally correct. Again, the opposite of this is something that we'd also like to explore. Possibly we can do that with you, Kate, which would be, what is the opposite of the transition risk? So what are the NAICS codes industries that are the alternative that banks should be looking at more investment in, or more exposure to? That would be the green list. So there's nothing wrong with doing that as well. But this is going to be, again, an effort, a bank-specific effort, although Ardmore is happy to share our list with you if you want to drop me a note. That's not a problem. Any comment, Kate, before I move on this, or do you think we've pretty much done
Nope, I think I'm good there. Thanks.
Okay. All right. Well, this is something that we created in the first proof of concept with a bank who had exposure nationally, more of a regional, institution, but with national exposure. This is relating to the NRI. So the NRI, the National Risk Index, it rates 18 different types of risk, and these are, some of them are not what you would consider an obvious physical risk. Just looking at them now, I mean, it includes the obvious ones like earthquakes and flooding, tornadoes, wildfires, and what they're doing is really looking at 100 years of data on the impact, the frequency and the impact of these events on these areas. But there are also some a little less, you don't think of as much. You can see in this example, we have cold waves, heat waves, hail. There's also things like river flooding, coastal flooding, and out west, where Kate is, she's got concerns about things like volcanoes, believe it or not, and landslides and earthquakes. There's even a tsunami rating for some of these locations. So this is a heat map, pardon the expression, that we put together. Now, the first thing you'll notice is that there's a expected annual loss composite rating, you can see, and then there are individual ratings for each type of acute physical risk. And I just highlighted the ones in red that were very high, and this is just an example. There are 18 of them, so it would have been a really long slide, so I just leave it like this, just to give you a sense. And it's very, very interesting because, I know in the first proof of concept, there was sort of a confusion from management as to how can this be? Like, why would, for example, Chicago be high risk? I mean, a lot of people would figure out why Miami might be high risk, but Chicago was a bit of a poser. And then, of course, we started looking at the fact that Chicago has cold, it has, potential for tornadoes in the Midwest. It's got, so it has flooding. There are a number of risk-related things. Wind, certainly if you've been in Chicago, you know that. And so that's why the aggregate rating is considered high, because of all these high risks that they have in different areas. The other aspect of this to note is you'll see that the first column after the composite rating is social vulnerability rating, and the second is a community resilience rating. These two ratings are incorporated into the expected annual loss rating. Not all banks necessarily want to include these measurements, but the NRI does include them. If you go into their documentation, if you go into the database, you can see that you can actually, pull out the individual ratings if you don't want them, but it becomes a little complex when you try to then roll them back up. But social vulnerability rating is based on the idea that low-income populations in a particular geo area are going to be more affected by a acute event than others, and how are these areas, in this case these counties, impacted socially that way. The community resilience rating is really about the ability of the community to rebound from one of these things. So some communities are in pretty good shape, like in the case of the examples here, Chicago has relatively high community resilience, but some other areas like Boca Raton and Miami do not, and San Diego don't necessarily have the facilities to quickly rebound from an acute problem. So again, this is not a perfect rating. A bank can control which aspects of the ratings they want to use, but it's it's free, it's well documented, and it's something that you can work with. So I think the real challenge that we had with this was getting the geo codes from the bank and the accuracy of those codes.
And I will
Kate,
say,
do you have anything you want to add?
yeah, in the results that I have reviewed thus far, Peter did a nice job of really elevating at this point to the high risk and the very high risk. And so really what it allows us to do is scope in on those particular things and then drill down in the details. So, again, some of these acute physical risks are, like common sense. But when it comes to applying it to the credit portfolio, it's a little bit different, a little bit harder, because this perspective, again, really allows the ability for a credit person or credit risk to understand a portfolio level how much of that particular credit you have in that specific area and what risk. And so to the extent that it's also segmenting the risks across the portfolio, it was very helpful for me to be able to see the very high and the high risk areas of the portfolio across all of the states that we're in one report.
Right. Now, if we did something like this for your portfolio, I think where we saw the highest exposure was earthquake, landslide, and volcano. Some of the holdings that you have in Washington and Oregon, I believe. So that's something a little bit different than what you're seeing in this particular bank.
Mm-hmm. Yep.
Okay, so some of the challenges that we have here obviously are using the NRI data, as we mentioned, has some aspects that the banks have to consider. It's free, documented, it's updated, but it's got some things in there that may not be as acceptable to management to be considered useful. It's not necessarily easy to understand because of the detail. As Kate mentioned, the idea would be really, if you've got assets in what they consider a very high or relatively high risk area, this is not to say that means you have to do anything with that. It means that it's an indicator that you might want to, as Kate put it, drill in further and look at specifics. But again, it can be a little confusing to present to management and the board unless they really understand where this is coming from. I think, however, it's free and it's relatively easy to use, particularly the county. For example, if you just have zip code, there's a free translation table that takes zip codes and puts them into counties. You could then attach the county code if you don't have it. You can do this on a spreadsheet if you're a small enough institution. If you have a database available, a credit data mart where you can, add user fields, you could do that way. I think the pros and cons. The pros are it's a start. It's the beginning, and it's not necessarily actionable data. And at this point, maybe actionable data isn't required. We're just getting started here with this. But it is something that can help you get started and get a sense of what's going on. And as we all know, vendors are going to jump in there because there's money to be made. And I should know, I'm a vendor. So people are going to offer all kinds of services. They're already, I mentioned Moody's. There's also others out there like Jupiter who will sell you very, very specific geolocation information, which includes much more granularity than the information from NRI. But again, is that an appropriate thing for a bank to be doing at this point? Perhaps, but that's up to the institution and their risk appetite, as Kate would say. And on the industry side, it's again, transition's a longer term planning cycle. It gets very directional because of the fact that there are no official lists of high carbon industries. It also doesn't take into account resiliency of a particular area of an industry, being able to change and adapt. So again, it's very directional on a high level. So, there's pros and cons to it, but we think from a proof of concept perspective, it's a good way to get started. And it's a way you can start to inform the board and management of this emerging risk. Before we wrap up the last two slides, anything else you want to add here, Kate?
No, I feel like, my main goal going in to this was to establish a baseline. And I think that again, and then understand what I have in terms of data, what I don't have, the different things that I'm looking at. And then, start to overlay that knowledge with at the state level in our particular footprint, as well as other things that could be future implications. So, again, this is a great starting point, I think, to help put all of this information in a box that somebody can make sense of. So it was a good exercise for sure on the proof of concept.
Great. I agree. And again, it's bankers like Kate and others of you out there who are forward thinking and, risk-forward institutions are interested in this. They're going to get an early view, and I think that makes them better positioned to react when regulatory requirements do come down the pike. So key points that we learned as we kind of wrap up this presentation, the CRE is a challenge. As I mentioned, there's so much CRE, and it in itself as a rent transition risk can be a little daunting. As well as the importance of collecting the location information. Even when we did get collateral location from the first POC bank's collateral system, we looked and a lot of them were the same as the address. So, in some cases, the data it could be suspect, but is a good thing to think about now. As we all know from going through credit stress testing on CRE and CECL and some of these other projects, having good data is key. So here we are at the end of 2023. Let's start collecting good data on location and good data on NAICS codes, because the NAICS code is wrong because it was put on by a lender who's just trying to get it through. You're not going to be able to take advantage of that information when you look at it from an industry perspective. There's also certainly some concern over this whole thing, political sensitivity and the like. We understand that. We're not advocating taking action with this information. I think that might be how some might misconstrue this to say, well, you're saying we should go out and start, not making deals in certain areas, and that's not at all what we're saying. We're just saying you should be aware of the risk. You should be aware of, insurance concerns. You should be aware of the acute risks of certain geographical areas. But we're not in no way advocating taking action based on this, particularly now when it's very foundational and directional at best. We did find that in one of the banks there was some confusion over what this information really meant, and different groups were using it already. The NRI data, some were using it at different levels, some had different assumptions on what it meant. Others looked at the details differently. So at least one of the things the proof of concept did for that bank was surface this as something that to get organized around and avoid redundancy at work and, sort of put governance in place. So even if that's all you do, there's value, I think. That's the bank ownership concern. And then to sort of wrap this up, and then we'll invite questions from the audience. It can be done. So the proof of concept objective was met, which was we were able to create concentration reports that gave directional information, foundational awareness to climate-related credit risk, using relatively easy to get resources. Again, using Excel or a database, just associating NRI with geolocation of collateral, associating the industry code of the high carbon footprint industries. It gives you a baseline, something that is imprecise and, not necessarily actionable, but something to be aware of. The transition risk is somewhat fuzzier for banks, and it seems to be more concerned about spending any calories on that at this point. But as I said, some of the states are making that decision for us, so we have to be aware of that as well. Next steps, I talked about data collection being key. I mean, now's the time to do it, because if you want to have a multi-year look back, you got to start somewhere. This exercise certainly exposed where there are opportunities to improve on collecting information at the time of origination, or going back and finding, scrubbing the data for the larger credits. You know, I think that next steps would likely be a credit stress test using the climate risk concentrations. Ardmore's been doing stress testing for banks for really since 2008. You know, and the concept there is primarily CRE segments. In this case, we're talking about segments of risk based on acute physical risk. How does that impact, you know, basic credit indicators like debt service coverage ratio, you know, collateral values, NOI. There already are factors out there that various groups like Moody's and others are creating, that they're talking about discounts in NOI based on having had an acute event. So, you know, that's where we're going with this. I think it won't be long if you collect enough data that you'll be able to do a climate concentration related stress test, shock that segment of the portfolio and say, what if these do have a significant impact, acute physical risk impact? What is the impact on the value of that property? So that seems like a very logical extension, but I think we need to continue to evolve in that direction, gathering the data that we need and seeing what it tells us. You know, those are really, you know, evolving best practices, and we were very happy to share with you our story on what we've done so far. And again, those of you who are interested in getting involved in this in some way, you obviously have our contact information through the folks at Bank Director. Kate, do you want to sum up your thoughts before we move to questions?
I think that really you've covered everything that, you know, the process really covered. I was gonna I guess I'll just sum it up in that gaining a different perspective, how your portfolio looks from a climate, from the NRI perspective especially, gives you a better understanding of how this might translate in the future. And so to that end, it's very educational to try and understand that and to work through the report. The other piece of it is that as we continue, you know, the different departments within a bank, you know, the ACL segments are set up in a specific way. The BSA department is set up using primary, you know, NAICS codes and other particular things. The CRA code really are essential to the bank compliance function. And there's an element of consistency that runs through these then that really pulls in the climate or this perspective on the climate risk concentration analysis as well. So I think part of it is just understanding how that looks in your particular organization, and then looking through the data with future eyes regarding what's happening at the policy level and what's happening specifically in your state.
Well, thanks, Kate. I appreciate you joining me today on this discussion and your work on this. Couldn't do it without you. So it's much appreciated, and I think your perspective is good. I almost forgot there was a third poll. So I'm going to ask Kia or Taylor from Bank Director to put this poll out there, and then we still have some time for a couple questions. This is the third poll, which is, where in the credit risk management cycle is your bank related to, is your bank regarding climate-related credit risk? A is you've not done anything. B is that maybe you're doing some research. C is you've laid some groundwork already. D is you're actually tracking it already in some degree. And E is that you actually got risk management practices in place. So if you could answer that poll, it's live. We'd appreciate it. You know, just trying to get a sense of, you know, what you guys are doing now. And I appreciate your time in answering this for us. I think it's, again, you can see the results now. If you go on, we'll leave it for a few more seconds so we can get answers. But it looks like I'm surprised and see that there's a good deal of research going on now. Of course, the people who come to a webinar on this topic would likely be more interested than those who are not attending. And some actually have risk management practices in place. Okay, I think we'll close that poll. Looks like 46% are researching and 24% have laid some groundwork, so that's great. And our last poll is really, and again, this is your feedback we appreciate. When do you plan to actively monitor and manage climate risk? A, you don't think you'll ever do that. B, when you're directed to by management, and C is if you're directed to by regulators, and then D is I'm already working on it, and E is I have no idea. So as our last poll, if you could give us your feedback there, that would be great. And we'll do that for about a minute, and then we'll see if there are any questions from the audience. So we'll give that a few more minutes, or not minutes, a few more seconds, I guess. Nobody's saying probably never. That's great. I expected someone to say that, but again, maybe they wouldn't come to this webinar to begin with. I don't know. I hope that people found this was useful information, and that this may help you think about how you can lay a foundational awareness in your institute. Okay, I think we can close that out. It looks like 33% are already working on it, which is great. Another 25% will do it when they're told to, both either by a management or by a regulator. Thanks. Okay, well, I think we're done here for our part. I know we have just a little bit of time left, so Kia, I would like you to, I will stop sharing and let us know if there are any questions out there that we can answer.
Yeah, before we conclude, I was just wondering if you could talk a little about the Scope 1, 2, and 3 emission designations and how relevant that is to kind of assuaging a bank's climate or credit risk.
Sure. Yeah, you hear this referenced a lot, particularly in the transition risk space, where they talk about the scope of greenhouse gas emissions. Scope 1, 2, and 3, this is probably going to become more important to banks when the SEC rule is published, which they now say will be sometime in the next couple of months. Scope 1 are the direct emissions of your company. It's within your control. So this would be, you would have to disclose what your company's fleet of vehicles, are they electric, hybrid, gas? Your buildings, are they green buildings? Are they not? Way you handle waste, all this kind of thing. So you're going to have to disclose that. The SEC is going to require for public banks probably 2025 for the large filers. Scope 2 is energy used to do the business on a regular basis. How impactful is the kind of work you do to the environment and from a greenhouse gas perspective? So if you are manufacturing, obviously it's an ongoing process that's going to be generating emissions, whereas a bank may not be generating as much to do its business. The Scope 3 is the one that is most feared by potential disclosures, because that's the indirect value chain, which I mentioned at the beginning of the discussion. In theory, the SEC rule was going to include that, saying that you had to look at all of your borrowers and all of your suppliers and what they were contributing. That, of course, is extremely frightening territory to a lot of institutions. It's pretty well undefined in how you would do it. So it's likely that that's going to be voluntary only in the SEC rule, but over in Europe, they're already requiring it. So it is happening. And those are the scopes 1, 2, and 3.
Well, that's all the time we have today. For the individuals that submitted questions that we weren't able to get to, we will pass those on directly to Peter so he can answer them after this. As a reminder, all participants will receive the recorded version of today's webinar within 24 hours. We'll also post this webinar on bankdirector.com. Thank you so much to Peter, Kate, and Ardmore Banking Advisors for co-hosting today's webinar. Thank you everyone for joining us today, and have a great rest of your day.
Thanks. We appreciate it. Thanks for your time.
Thank you.